Welcome back. In this video, we are going to briefly understand options. An option is a contract that gives the buyer of the contract the right but not the obligation to buy or sell the underlying at a specific price within a certain time period. The underlying in an options contract can be a stock index, commodity, or currency. In an options contract, the buyer of the contract has the right to buy or sell a security. However, he may choose to not exercise his right if it is not profitable for him to do so. The buyer of the option contract buys the option from the seller, so the option seller is the counterparty to this trade. The seller of the option is always obliged to buy or sell a security depending on the type of option. Let's understand this with an example. Say you want to buy a diamond ring in 3 months. The price of this ring is $35,000. You feel that the price may rise in 3 months' time, but since you don't have enough money right now, you cannot buy the ring immediately. Let's say you negotiate with the seller that he gives you the option to buy the ring after 3 months at today's price of $35,000. The seller agrees but asks you to give him $500, which is a price for providing you this option. Now consider two situations. Let's say the price of diamonds increased during this period of 3 months and is now at $39,000. But since you bought an option to buy this ring at $35,000, you can do so, and so it will save you from this price increase after adjusting for the options price you paid. So you will be saving $39,000 minus $35,000 minus the $500 you paid for this option. This comes to a saving of $3,500. It may also happen that the price of diamonds actually decreases over this period, and so let's say if the price of the ring after 3 months is $31,000, now instead of paying $35,000 for the ring, you can forego this $500 option and instead you just buy the ring from another shop for $31,000. So by negotiating an options deal, you had the choice to buy the ring without the obligation to do so. Now let's look at two basic types of options, which are call option and put option. Call option is an option that gives the buyer of the option the right but not the obligation to buy an asset within a certain time period at a certain price. The last example we discussed on buying a ring was actually a call option. By owning a call option on the stock, you essentially have a long position in the stock, which benefits if the price of the stock rises. Another type of option is the put option. Put option is an option that gives the buyer of the option the right but not the obligation to sell an asset within a certain period of time at a certain price. By owning a put option, you essentially have a short position in stock, which benefits if the prices fall. So from this it should be clear that there are 4 participants in options market of any asset. These are the buyer of the call option, the buyer of the put option, the seller of the call option, and the seller of the put option. As far as the buyers of the options are concerned, they are not obligated to buy or sell the asset. They can choose to exercise their rights only if it is profitable. As far as the sellers of the option is concerned, they are obligated to buy or sell the asset if the buyer of the option exercises his rights. Whenever the buyer of the option exercises his right, the seller of the option will be at a loss and will need to fulfill his obligation. Since the seller of the option is obligated to buy or sell the asset on the wishes of the buyer of the option, the seller of the option gets compensated for this in the form of options premium paid to him by the buyer of the option. This premium is paid to the seller at the time of initiation of the options contract. If the contract expires and the buyer does not exercise his right, then the seller of the option gets to keep the entire premium, and this entire premium becomes his profit. If you are a new investor, I would suggest to stay away from futures and options until you have sufficient knowledge to handle this kind of risk. For now, we are going to move to the next topic, so see you in the next video.